Hello, and welcome to another video from the Toledo Regional Chamber of Commerce and the Toledo SBDC. Today, we're going to talk about cash budgeting, and this is something that many small business owners and entrepreneurs often fail to do or fail to understand, and it can be incredibly beneficial and reduce a lot of stress, especially for those of you that are working in seasonal businesses. Cash budgeting allows you to stop relying on personal credit cards, stop relying on personal loans, scrambling for cash during the thin season. And it's really not that difficult, and it forces you to think in certain ways about your business operations that are healthy and kind of a critical look at the way you're using or collecting cash. So if you are interested in this template, you can contact the Toledo Regional Chamber or the Toledo SBDC at the email below and get a copy of it to kind of fill in your own numbers based on your results. So I'm going to walk through what a cash budget is and what it's used for. And we're really going to see this in 2 or 3 separate points. Okay, so the first topic we're going to talk about is the revenues and your sales versus your cash collection. So there's all kinds of things that we can do to measure that. Something called a cash conversion cycle is really important for you to understand for those of you especially selling products. But the cash collections are different than sales. And that's a lot of, it's the creator of a lot of issues in small business, especially those without financial instruments to borrow from. So let's just take a look, kind of jump right in. But remember, this is a cash budget, not a profit and loss statement. So we start first, as you see there, at the cash at the beginning of period. So in January, February, and March, this would be like a Q1 cash budget. We're going to have $2,500 beginning balance in January, and then we want to go up to $5,000 of beginning balance in February and March. So we know that because we would know what we have currently, right, in our bank account, and then we would project out the next couple months. So we're projecting sales, and you can see this is a lawnmower sales business, so this has a lot of seasonality. In January, it's very slow, but in February and March, spring's kind of on the way. People are starting to buy lawnmowers. So we project out our mower sales and our parts sales, and you can see that in these columns here, where we're going to project those items. And this is based on either historical data or the owner or yourself, gathering some market data. It can be just a best guess. There's really no hard scientific way to do this that's feasible for a small business. But here's what a lot of people overlook is that even in seasonal businesses or small businesses, there's typically some type of cadence or pattern as to how the cash rolls in. So if we're going to do a total mower sales of, we'll say, $10,000, and we believe we're going to sell just better than $12,000 in parts and service, we need to know that we're probably not going to walk away from that month with the total amount, right? So the mower sales, we might collect that right away because a lot of times the mowers are financed, and then you get paid for that financing right away, and the finance company takes the loan. So we're going to assume that we get paid right away for the mower sales. Now, however, these parts and service sales, we look back at historical data or we make our best guess, and we can see that we normally sell 75% on cash and credit, which would be collected right at that point in time. But a lot of those are going to be invoiced out, right? So we might give do the work and give the part and give the client or the customer their machine fixed with an invoice with net 30 terms. So we believe 20% of our sales for parts and service for January aren't going to be collected until February, and then the remaining 5% collected in March, assuming that we get to collect all 100%, which could be adjusted as well if you're not in that type of business. So the key here is to realize that your sales for any given month aren't going to necessarily match your collections for that month. That becomes very important when you start looking at paying for parts in this situation, or paying for labor, or paying for fuel. When you have immediate expenses, which we list here in this second section, we're going to discover in a second, you have immediate expenses, but you have a delay in your collections, you need to plan for that. So again, if you leave all the technical stuff aside And just realize that's the point, right? We want to make sure we have enough cash to operate our business. Part of understanding how to get that amount of cash or how to keep it is understanding the delay in paying for inventory or paying for labor and the collections of the sales made because of that inventory and labor. So I always like to break things up into variable costs and fixed costs. I think this is very telling. Variable costs tend to move in some relationship, usually a strong relationship with sales. So you can see that we're going to sell $10,000 or one mower in January. In February, we're going to sell a few mowers, getting near $45,000 with the same thing in March. Well, if you look, the current mower cost, right, we're going to buy these mowers to sell them, is going to roll with the variable cost. In this case, the mowers are purchased the same month in which they're sold. The parts cost, again, is variable depending on the amount of sales that we have, and these would even operate on a net 30. So there's some delay there, but we need to make sure we're planning for the cash that goes out, not necessarily what's, ordered. Again, we're coming off of this profit and loss view onto a cash moving back and forth view. And there are a few other small variable costs, but again, those costs go up and down with sales. You don't typically have a variable cost until you have sales or until you have work that you need to complete. Fixed costs, on the other hand, are just that. They're mostly or essentially, or we'll say probably fixed. They're probably about the same regardless of the amount of work. Now, there are very technical definitions in all the accounting books, and that's fine. But realize that sometimes there'll be a little bit of variance here, and that's okay. If you want to talk more about fixed cost or learn more about fixed cost, there's another video on the website about burn rate, which is very important. And then there's also another video about the profit and loss statement. So I'll let you go to that video to see the details of what fixed costs are and how to arrive at those. The other thing that we put in our cash budget that we may not put in our profit and loss would be capital expenditures. So if we need to improve our building, if we need to improve our land, if there's some type of showroom that we want to build, those would be put in. And here's when you get into the difference between accounting systems. A capital expenditure would be a cash purchase now, but a lot of times you don't actually see the expense until you depreciate that asset. I'm just going to stop right there. I'm not going to go into depreciation. We could do another video, or you can ask the SBDC or the Toledo Chamber for some help understanding that. But realize that, cash budgets track your perspective or likely cash movement. And what we're doing here, we might sit down in December or November and project out Q1. So as we go down, we look at owner's draw. We see some of the pay that we might take out. But here's something that we have, to understand. And a lot of people overlook this. There is some minimum amount of cash that your business should keep. It's too long and too pointed of a conversation to have on a video, but there is indeed some amount of cash your business should keep on hand to be sure it's operating so you don't miss out on other opportunities. And that's what this provides. So this particular business decided a $5,000 cash minimum was what they wanted to keep. So if you take a look at this, we have our cash on hand here, which is this $2,500. We have the amount of sales that we're going to make, but we also change that around a little bit to show that we're not going to collect all of our sales right away. We'll actually collect sales over a 3-month period, right? And then we're going to do the same thing for the sales in February. We would collect some of those in April for a 3-month period, and that would continue to roll on. We have our expenses. We have our cash collections, or let's just start from the beginning. We have our cash balance. We have our cash collections. We have the total cash outflow, okay? And in this case, we actually have a negative cash position at the end of the month because it's a slow month and we're buying parts and getting ready for the upcoming month. So we'll have a little bit less money coming in than we have coming out. Not a big deal if you already know about it. But what that does is that tells us that we need to have a credit line or something we can tap into to keep our $5,000 minimum balance. So in January, we're going to start with $2,500. We'll end with a negative cash position of $3,400 and change, which means we need to borrow $5,981 to have that cash ready to operate our business. Now, we'll then roll into, so that gives us an ending balance. That'll become the beginning balance on our next month, right? And then we're going to have, again, a cash outlay, a cash position, and then we can start paying on the credit line if we need to. And then we have, again, a minimum balance. We've got a solid cash inflow, and we can start paying on the credit line a little bit more as well. So, again, the details of this, it's always helpful to do it with your own business. It's always better to have somebody kind of walk through your actual situation. But a cash budget looks at your beginning cash balance, your expected sales and the collections from those sales, your expected cash outflows, and then uses a little bit of planning and maybe a credit line or some type of instrument to be sure you have the cash position you need to operate your business and take advantage of opportunities should they come along. I hope this was helpful. Again, if there's anything that we can do to help explain this, please reach out to the Toledo Chamber or the Toledo SBDC. Thanks a lot.